Hi, everyone. Thanks for joining us today. I have John Park from PGI SelfDirected. He's the president of PGI SelfDirected. John and I have known each other for 4 or 5 years now because I did a lot of research on when I first started my Solo401k. I did a lot of research online, read a few recommendations on Bigger Pockets. That's how I found John. And I start work with him, and it was great because he's giving me a lot of guidance, a very customized approach to that. So over the years, I'm an apartment syndicator. So over the years, I've had a few of my investors sent to John and to some other financial services too. And the feedbacks from my investor that I sent to John was always positive. So over the time, we built a really good relationship over there. And I just want to introduce everybody to him. And their firm kind of provides all sorts of services for all different kind of alternative retirement plans. So I know this is the number one question asked from my investors, is how and which vehicle to use for alternative retirement plan. You know, the answer is always depends. So I thought it was a really good time for him to come in and give us kind of a whole gamut of all the alternative retirement plans that's out there, and kind of take them one by one beside each other and give us some insight to demystify which one that you should be going after. Cool. Welcome, John. Hopefully I covered some introductions for you, but if you can kind of tell us a little bit about what you do at PGI SelfDirected, that'd be great as well. Yeah.
Well, welcome everybody. Thank you, Elisa. And PGI, it's pretty simple and straightforward. All PGI does is set up the self-directed retirement accounts. We set up what's commonly referred to as an IRA LLC. We're one of the few companies that sets up an IRA trust, and we'll probably be talking about that. And then the Solo K. So, like I always tell folks, is we're not selling investments. We're not here to sell anything to folks. We're creating the structure, and we set up whatever fits best for the client, and we'll probably be going over kind of like what those options are, and then the preferences as to what somebody might be able to qualify for.
Awesome. So John, do you want to kind of just go through, so the formats of the events over here, just want a few housekeeping thing, and my Facebook Live just stopped, so I'm going to restart over there. Reason why you want to join over here for premium experience. So please put your question in the Q&A, and thank you for Dwayne that's already doing it. We're going to answer them live. But John does have a first section of our presentation is he's going to go and share his screen with the PDF that he has provided, basically made available for us. After the call, I'm going to be sending out as a follow-up. But he's going to walk us through all different kind of retirement vehicles and what you can do to invest. Over the time, I'll probably have some questions of my own for him, and then I'm also going to address any questions that you leave in the Q&A box over there. And the chats, you guys can tell jokes, talk to each other on chats, but the Q&A box is for question and answers. So put your question over there. All right.
You can do all your jokes about me on the chats.
Can't think of any right now, John.
Just give me some time.
Yeah. Great. Awesome. All right. So we'll have John started with, do you want to share your screen, John?
That's what I'm not sure what you're wanting me to do as far as sharing the screen. So forgive me. I'm not sure what you're wanting me to do with that.
Oh, okay. So I wanted to kind of show actually who can share. All of you guys can share. Okay, so let me change the perspective. So I think you can share now. Basically, that PDF form that you have created for me, the product list of all different kind of retirement funds. Yeah.
Okay, so let me see here. Would I just be going to?
I can do it for you too.
If you're able to do it, I'm not exactly sure what I need to be doing.
Sure. Yeah, I'll do that.
Okay.
So perfect. I'll do that. Let me know when you folks can see my screen. Still sharing. Okay.
There we go. So you just want me to go ahead and get started, Elisa?
Yeah, go ahead.
Okay, so folks, there's really three components to self-directing. The one, we're going to talk about the two IRA ones first, and then we're going to go to the solo K at the end. I'm going to tell you right off at the beginning, I have a strong preference for the 401k. I think it's better for folks. But the key is you have to qualify for it. So, it doesn't mean that the IRA, self-directed IRA, either through an LLC structure or a trust structure is bad. It's just there's so many benefits attached to the 401k. So as we're going through this, let's just talk about the structure first of all. If you're anything like me, I've been to seminars before where they pretty much read everything to you. So these are really intended more to be bullet points because I don't like reading to people, but they're more bullet points for us just to kind of stay on topic of what we want to talk about. So most people, they may or may not know that with a self-directed IRA, they can not have a checkbook control feature, or they can. For a individual who is not wanting a checkbook control feature, that would be if they called a self-directed IRA custodian and they just said, hey, I want you to control the funds, I'm going to pay the fees, but I want you to do all the paperwork associated with my investments. And there's nothing wrong with that process, but most of the people that I ever work through and with are already wanting that checkbook control, because bottom line is I always portray the visual of is think of you taking a checkbook out of your pocket, and that's really kind of how it's structured. You are going to be able to make investments on behalf of the IRA without going back to a custodian for any permission, review, waiting on them to process things, etc. Also, I'll just touch on this real quickly. Typically, the IRA LLC structure and the IRA trust structure over time is actually going to save people money as well. So most of the people I talk to, their initial interest is having that checkbook control. But then when I tell them that there's a very good chance that they'll actually save money in fees over a period of time, well, that's just kind of an added bonus. So when we utilize the IRA structure, we actually capitalize the funds from the IRA directly into an LLC account. So think of it visually as this way. A lot of you would be rolling over or transferring funds over from another institution. So that money goes to the new self-directed IRA custodian in the form of most likely a transfer, where it's just going from one IRA to another IRA. It's not obviously taxable. It's not even reportable to the IRS. It's just a transfer. Some of you may be rolling over funds where that's reportable. It's not taxable, but think of a rollover as being like to unlike, or in the case of maybe an IRA, somebody having maybe funds in an old employer's 401k plan and then rolling those funds over to the IRA. But regardless of how the funds get there, those funds get to the IRA custodian. Then where you're utilizing PGI services is we're creating that IRA LLC structure. So at the end of the day, two things happen for you. Number one, we're providing the documents to the custodian because they're going to require them for the LLC so that they can release the funds out or capitalize that LLC account, of which you are going to be the manager most likely of that LLC, and that's going to be at a local banking account where you live and reside, etc. When we set this up for it to be totally legal, there's going to be three documents. There's going to be an EIN for the LLC. There's going to be approved articles for your LLC from the state in which we're forming the LLC. Most importantly, and what, because those first two things most people could do on their own, most importantly is going to be the operating agreement for the LLC. When that LLC is set up, there's going to be a member and a manager. For those of you who have LLCs, you're already familiar with this terminology. For those of you that don't, the member, just think of the member as the owner of the LLC, and then the manager is the person who conducts kind of like the day-to-day activities. Most people, when they're setting up the IRA LLC structure, they're going to be the manager of the LLC. But one thing that will not vary is the IRA is always the member. It is always considered the owner. As the manager, you're just conducting the activities for that LLC as far as making investments. Another option you have with the IRA LLC structure is what I just call a family LLC. Typically, folks, how most of this works is when you have spouses who both spouses will say, hey, we want more purchasing power. We want the ability to, take both of our IRAs, and instead of having two different IRA LLCs, we would prefer to have all those funds from both IRAs go into one LLC account. Is that legal? Yes, it is. It's just considered a multi-member LLC. There's a couple drawbacks in doing that. They're not insurmountable things at all, but when you have a multi-member LLC, and this has nothing to do with IRS rules, bottom line is anytime there's more than one member, even if there's no taxes due, a partnership return, tax return still needs to be filed, even if it's informational. So in the case of your IRAs, you'd be saying, well, my IRAs don't owe any tax, correct, because I'm just investing the funds, and if it's a pre-tax traditional IRA, I'm going to get taxed as I take out the money. If it's a Roth IRA, I'm never going to have to pay taxes on it, etc. And the answer to that is, of course, yes. But the IRS is going to say, if there's more than one member, or in this case, more than one IRA, you will still have to file that partnership informational return. So some people don't want to do that just because it's kind of a little bit of a hassle. The other thing too is that when that IRA LLC is formed, the percentages cannot change. So if two spouses come in, for example, and basically their IRA accounts, let's just say, are exactly the same, it's 50-50. It's pretty cut and dry, pretty easy peasy, etc. But when I have clients who go, well, my IRA is 90,000, my spouse's IRA is 10,000, now we're going into the creation of that operating agreement as a 90-10 percentage ownership between the two IRAs. Now here's the thing. Moving forward, those percentages can't change. They always are going to have to stay 90-10 in that structure. So that's kind of a hassle, because if it's 90-10 and two spouses come in and say, hey, I want to contribute 6,000 to each of our IRAs and then move that money out to the LLC, I can't tell them what to do. It's their IRA LLC structure. PGI is just creating it for them. But if they're asking me what they should do, I would say, no, you can't do that, because you have to maintain that 90-10 percentage. The LLC bank account, for the most part, is going to be held at your local bank or credit union. Now, we do have a relationship with TD Ameritrade. We're not paid by TD Ameritrade in any way, shape, or form. But for those of you who said, hey, is there any way I could open this LLC account at a brokerage firm? Most brokerage firms won't open it. They just don't get involved in this space. TD Ameritrade is an exception. And so just know that if you were creating an IRA LLC structure, you wanted a brokerage account option, you still have checkbook control of the funds. TD doesn't control your IRA LLC account. It's not theirs. It belongs to the IRA. They just allow you to have the account there, which is nice because, like I say to folks, you can literally do anything and everything all from one account. Key points with the IRA.
Yeah.
And how do I slide this down? Or are you?
I'm doing it.
Thanks, Julia. Thanks, Alicia. So key points is just remember that all investments, this should be kind of common sense to folks, but all investments are made from the IRA funded LLC. All investments and assets are titled in the name of the LLC. Now, here's where somebody might say, well, okay, I guess you're kind of right with that, John, but if they're IRA funds, so it just seems kind of weird that the LLC has to be on the titling. Shouldn't it be the IRA? No, because in this case, when you move those funds to the LLC, your IRA is making an investment or capitalizing those funds into the LLC. It owns the LLC, so any monies that are being made from an investment from that LLC must be titled in the name of the LLC. Finally, and this is confusing to some folks, it's not difficult, but I understand the question. Anytime you make a new contribution, or for example, if you're over the age of 59 and a half and you were starting to take out distributions, so any contributions to the IRA or from the IRA must always be made from the IRA. You just don't take the money out from the LLC and give it to yourself, even if you report that as a taxable distribution. Why? Because one of the responsibilities of the custodian is they actually have to report to the IRA annually any new contributions, any distributions, fair market value of the LLC or the IRA in this case, which holds the LLC. So just remember, if you're making contributions, distributions, you can always call me, always ask questions. But bottom line is just don't take a check and write yourself a check out of the LLC. That would be a no-no. Finally, with any IRA or qualified retirement plan with the IRS, you have the prohibited transactions. I'll touch on them real quickly. You have IRS disqualified assets. So in the course for an IRA, there's two assets that are strictly disqualified. One is collectibles, one is life insurance contracts. I have very few people who are ever interested in investing into life insurance contracts. However, I get the occasional person who says, well, hey, if I bought a 1957 Corvette, which I think is going to appreciate in value, that has to be okay, right? Well, no, because the IRS would consider that a collectible, and they're just going to say no collectibles, no life insurance. The next thing that you want to be wary of are disqualified individuals. And think of a horizontal and a vertical plane crossing each other. You and your spouse, if there is one, are disqualified people to your IRA or both of your IRAs. So if one spouse had an IRA LLC, but the other spouse's funds were not part of that, they're still a disqualified individual. Bloodline children below you, upline ascendant disqualified people, grandparents, parents, etc., above you. So if you just go up and down that vertical plane and stay away from doing investments with children, conducting business with yourself with those funds, staying away from parents, grandparents, etc., you're going to satisfy that. Now the horizontal plane of that is who's on that plane. So brothers, sisters, aunts, uncles, nephews, nieces, cousins, strangers, friends, business associates. Those are all people by definition that are not disqualified to the plan. And somebody might say, well, gosh, that seems weird that the IRS would say that you could, you can't do something with your kids or your mom or your dad or your grandparents or your spouse, but you can do something with your brother or sister. Yep, that's just how the rules are written. Most people think it was the IRS's intent to limit any family members, but that is not how the code is written. It only disqualifies the people that I mentioned. Finally, IRS self-dealing. It just simply means you cannot conduct business with yourself. So let's just use an easy example because this can get complicated depending on how inventive people are trying to be. So, if you were a real estate agent and you said, hey, I have a self-directed IRA and I want my IRA to go out and be able to purchase a property, and I'll get a commission for that. I'm a real estate broker. Well, if they call me and if they say, hey, John, can I do that? I'm going to say, well, I can't stop you from doing something. You control your own account. It's self-directed, but that would be a self-dealing transaction because now you are personally benefiting from something that your retirement account's doing. Okay. Now, Lisa, I don't know if you want me to continue or stop with questions on the IRA LLC, or you tell me how you want me to proceed.
Yeah, so we do have some questions over here. I think it's a good time to address some of them. And specifically, I think some folks still, yeah. So basically, one person was asking if we're going to talk about self-directed IRA and invested that for real estate investment. Yes, I think we will be getting to more of that in the Q&A session. The same person also asked, how about UL and IUL cash fund for real estate investment? What is the UL, IUL kind of stands for doing, or maybe John?
Well, the IUL in my world would tell me it's a universal life policy.
Mm-hmm.
And so that would be a life insurance contract,
Okay.
which normally speaking,
concept.
would not be able to be invested into.
Yeah. So this is a separate concept. I think we'll have a different session to cover that, because this is actually had to do with whole life insurance and the infinite banking concept, which is you're taking a whole life insurance policy. Essentially, you're borrowing from that fund and then use that to invest in real estate investment. Not something John is specialized in because that is not a retirement fund. But yes, so I think if that's universal life policy, I think that's what that is. There's some benefits to that, but specifically, the alternative retirement funds addresses the fact that people who has money that kind of just sitting on the sideline, or they're limited to only invest in 5 to 10 mutual funds from their, previous past employees requirement. And then they can potentially free these up so that they can actually invest in notes, invest in passive investments for syndications and etc., or invest in, basically they can actually invest in a property, not self-dealing property, but invest in a property using non-recourse loans and etc. As well, which John, you'll probably get into talking a little bit about that too, right? Investing and re-esting. What are some stuff that they could do? What is self-dealing? Now, interesting enough, I want to kind of bring this up. Me and John had this conversation earlier this year because we have an asset. Basically, we need a little bit more extra cash to manage. So because I'm already a general partner on the deal, so I can't just lend to the property directly. However, I could take out a personal loan like $50,000 on regular year. If you have COVID hardship, now it's 100K. We covered that in a previous session with Naomi on that. But specifically, I could have then moved that money, basically lend it to myself as a loan, and then myself then lend it to the property. So that was okay, right, John? So it's a
Yeah,
little creative, but
yeah,
it's not
we were
self.
talking about your solo K at the time, but yes, you can
Yeah.
take out a participant loan from your 401k.
Yeah.
Absolutely.
What about for self-directed IRA? Is that like, does that policy kind of also apply to the self-directed IRA?
Not as a general rule. With COVID, they've loosened that up a little bit, but the normal rules for an IRA are based on hardship. So that's one. When we get to the 401k, we'll talk about some of the benefits of the 401k. That's
Okay.
definitely one, is that a person can take out a participant loan, where generally speaking with the IRA, there are no loans.
Mhm. So I have another question over here from one of the listener about SDIRA, non-checkbook control. So I'm guessing if you're working with Crest or Benta, you usually have a custodian working with you. That's what it means. If you have a UBIT tax due, and again, John's going to kind of get into what UBIT tax is. That's actually one of the differentiator between SDIRA and Solo401k. But the question was about SDIRA, non-checkbook control. If you have a UBIT tax due, let's say you file SDIRA taxes, then later when investment is sold, will capital gains or recapture depreciation taken into consideration when in an SDIRA type account investment?
Well, that's a loaded question, and that's a good one to also bring in a tax person on. But generally speaking, when your IRA triggers either UBIT or UDFI, which is a subsection of UBIT, UBIT, by the way, folks, just stands for unrelated business income taxes. The easy explanation is if you're actually generating active income versus passive income. It's not that it's illegal, but the IRS says, hey, you're going to have to pay a tax on that now. UDFI is definitely, something that Elisa is very familiar with, because UDFI stands for unrelated debt financed income, and it basically just represents a situation where there's an IRA investment that involves leverage. It's not illegal, but if the IRA is part of that investment that involves leverage, there will be some potential, and I emphasize potential, chance to have a tax associated with that, because there's leverage funds being used, which, by the way, when we get to the 401k, that's one of the benefits of the 401k, because UBIT applies to any retirement plan, but UDFI, that subsection, does not apply to a 401k. So for you potential investors, if you are self-employed in some capacity, or could be self-employed in some capacity, because you're also thinking about making an investment that might trigger that UDFI provision, a 401k is a huge benefit to you.
Gotcha. And so thank you for that. And then now when you say it could, like any rules, there's no like a fast yes and no. So if for some investor, they already invested in a fund with self-directed IRA, first of all, I know this, that we can later actually convert you to a solo 401k while we hold the property. You basically need, if you're working with a syndicator on this, you basically need a reassignment of a share, and work with your syndicator to change the paperwork, et cetera, for that. So at the exit time, you may qualify for self-directed 401k, solo 401k, and essentially kind of avoid the UBIT tax. So that's one way you can work on this. Others I've kind of heard, and this is a question for John, you could use the depreciation and use that to kind of offset the gain. So it is very scary. People will say, oh, you have up to 39% of the UDFI tax, essentially. But at the end of the day, it's the proportion of the gain that's what really being taxed on. So if you can use your depreciation to kind of offset the gain, then it's kind of like a moot point. So it's not as scary as some people maybe make it sound like. However, and sometimes I make you sound like, however, if there is options to switch to a solo 401k, may be a better course before you exit the deal.
Yes, I'm glad you said that, because I'll give you a good example. I was doing a seminar once, and somebody, it was for an investment sponsor, and somebody came up afterwards and they said, oh my gosh, I'm scared to death that I'm going to have this tax, blah blah blah. And she actually had her statement with her from the investment sponsor. And I said, well, I'm not your CPA, but let's just take a quick look at it. And it was negative 17,000. So it's like there was all the depreciation there. So I said, it's not, first of all, you have between $0 and $1,000 anyway on the positive side, where you don't have to even be worried about it. It's only once it goes over $1,000. But I just told her, I said, a lot of companies, there's, the depreciation, there's the write-offs, everything else associated with that investment, where a lot of times it doesn't even creep up at all. But if somebody's going to have it, and if they are self-employed, then it's just a nice benefit to be in that 401k wrapper.
Right, because then you don't actually have to worry about calculation, etc.
Right.
Now, John, this is a typical topic. Sorry to kind of get into a little bit more deep, because UBIT and UDFI is a very, very much asked the question. So one question around that is, it is very typical the type of investment our investors are doing by investing in syndications, etc., especially apartment syndications, or anything to do with building that has depreciation, even commercials and etc. We do give them a bonus depreciation up in year one, so that's a very much a negative number with K1s. And subsequent year, usually it offsets all the rent income, the depreciation due. So really, until when they exit the projects, that's where this big chunk of gain is coming in. And also, if you're using bonus depreciation, oftentimes it's heavy loaded on the front, but at the end, when you release the asset, you actually have to pay back the depreciation possible penalties, right? Even though sometimes it's a lower tax bracket than what you would pay. So that's when that kind of catches up with you, right? So even though during the years that they're holding it, it may be a negative K1, but one-way strategy to kind of do that would potentially be convert that into a solo 401k if they qualify at the end of the project.
And by the way, this would probably be a good time, Elisa, for me to pass along one of our past conversations about kind of sometimes what happens in this business. I am definitely not wired to have tons and tons of creative thinking, how some companies are in being self-employed. Now, saying that though, I will be the first to say that it is very easy to become self-employed, because the IRS's standards for that are pretty much that you're just carrying on an activity for the intention of making profit, and that you're carrying on that activity on a routine basis. Routine, they don't define as every day. They don't define it. So what I tell a lot of people is, if you really want that solo K, all you have to do is just do something that generates activity in the eyes of the IRS, and then hopefully, obviously, some active income. So it's not that hard to qualify for the 401k, and it's just a nice tool to use if you can.
Yeah, gotcha. So along that line, then, just to kind of demystify this, if I was to help doing a contractor work, for example, I'm delivering grocery for Instacart or driving Uber, is that activity enough to kind of qualify me? I know, like, as a seller on eBay or a seller on Amazon marketplaces, are these all activities that can qualify me as a solo 401k?
Absolutely. Everything you just said would qualify as for a solo K.
Gotcha. So something that you're actively doing. Again, none of us are tax professional here. I think one key member in your inner circle team is the CPA. So taking this information, definitely vet with your CPA, because my CPA actually has planned it with me when I did all these activities. I do actually self-manage a few of my properties. And he looked at a book, and there was some internal process that he has. And then he basically said, yeah, that's enough activity. If you only, manage one single family, that may be not enough. But if you manage it like 4 or 5, that's enough. So it's kind of a gray line over there. But, my CPA makes sure that I'm out of trouble. So definitely working with your CPA on this as well.
Yeah, and Elisa's heard me say this before, but I'm not one of those persons who says wink, wink when I'm talking to somebody. I'll just say, hey, you have to qualify for it, but it's not as difficult as you might imagine. And here's the better question is, if the benefits far outweigh the negatives, is it worthwhile for you to create some level of self-employment activity?
Definitely, yeah.
Should we
Great.
go to the IRA trust next?
Yes. Well, I think there is other questions. Just want to make sure that I address them.
Sure.
So there are people asking about solo 401k question. I think we do have another section on the solo 401k later on, so we'll address it during then. One more question on the self-directed IRA, and then we'll move on to the IRA trust. Someone's asking, using self-directed IRA, buying a tax-lien property, can I sell it to my another real estate LLC? I think there's some questions there that we need to ask, right? Like, can I sell it to my other real estate LLC? So I'm guessing your other LLC is also owned by you?
Then it would be a no for sure.
Okay, because it's self-dealing.
Yeah, it would be self-dealing.
Gotcha. Cool.
Even though there's tons of people who do those things, but technically speaking, that would be a prohibited transaction.
The thing with IRS is, you know, if they don't audit you, never get into trouble. But if you get audited, then there could be very heavy consequences.
Yeah,
So,
here's the analogy I always use. I could say on my tax return that I have 60,000 in write-offs on my tax return. I might only have 30, and I might never get caught doing that. But bottom line is if they audit me, then that's when I have to be prepared to show 60,000.
yeah, gotcha. Cool. Okay, I think we're good to move on to the IRA trust.
Okay, so I'm going to go through this one pretty quick because anything that I just explained about the IRA LLC, having the checkbook control, kind of that, if everybody grasped onto that visual, it's the exact same thing with the trust. You're still going to have checkbook control. Instead of a LLC, it's going to be a trust. It's a revocable grantor trust. Instead of your IRA being the member of the LLC, the IRA is now going to be the grantor of that trust. Instead of you being the manager of the LLC, you're going to be the trustee of the trust. And somebody might be saying, well, why do you even have this? And here's the main reason. There are going to be some people possibly on this call, but for sure in other parts of the country that live in states that have high costs associated with their LLCs. I want to pick on the lovely state of California. You form an LLC in the state of California is going to come after you for $800 a year, even with this kind of a structure, because they don't care whether it's an IRA or a 401k. They don't care. They just say, if you form an LLC and you're a resident of the state of California, you're paying us $800 a year. So back in 2017, I think there was one company at the time that was doing the trust. And I went to an attorney up in the Seattle area who we knew mutual acquaintances, and they thought we should talk. And I spoke to the attorney and I said, I got a lot of clients in California, and I can't stand the California Franchise Tax Board who assesses this $800 a year tax. What about a trust? And he said, hey, give me some time to think about it. Long story short, he came back and he said, yeah, this is a wonderful idea. So when we do the trust, not only do I work through an attorney on that who designs the trust, writes the trust, etc., which is what you guys want. You want that trust as developed by an attorney, not by just somebody like John, who's not an attorney. And we set up that structure for people. But again, the primary reason is going to be for people who don't want to get saddled with high LLC costs in the state in which they reside. Now, there's other benefits, and one of the things, like I think Elise is going to send out something later. One of the blogs you're going to get in something subsequent to this is where I've talked about a comparison between an IRA LLC and an IRA trust, because most people will do the trust if it's cost savings to them, but there are still some other advantages to the trust over the LLC. And I'll give one right off the bat, because Elisa, this may affect what you do. Is when you have an IRA, when you have any LLC, and you live in one state, and let's say you're interested in an investment in another state, not only do you have to have your LLC in your resident state, you may have to form what's called a foreign LLC in that state of which that investment is taking place. Like if you were buying a property, well, that can start getting costly for folks if you're doing stuff outside of the normal state lines. Think of the trust as we've all walked in front of a store that has the neon light that says open. The trust is open to do business in any state. It is not governed by state regulations. So bottom line is you can do a trust and purchase properties, et cetera, in other states. That's not a problem at all. Here's one negative. If you said, hey, I'm trying to do some leverage investing, meaning where my IRA goes out and borrows some of that money like we were talking about earlier, it's almost impossible for a trust to get a loan. Almost impossible. I've never heard of it. So if somebody came to me at the beginning when we're talking and they were saying, what's better, IRA LLC, IRA trust? That's one of the questions I want to ask them is, if you're not planning on doing any kind of non-recourse lending through the IRA, good chance the trust might be a good option for you. If you're thinking about getting some leverage funds, do not use the trust.
Gotcha. So let's just kind of put it into a little bit more real example over here to help my listener kind of wrap their head around this. So if I was a investor that lives in the state of California that has a very high income tax, I can't remember any other state that has a very high income, I guess in New York maybe. Pardon me for not knowing that because I live in Washington where I don't pay income tax. So basically, so that would be a good candidate to potentially looking at the trust versus IRA, kind of the regular IRA,
Absolutely.
self-directed IRA.
Yeah.
Gotcha. And then the other thing is, if I was, we did that. One of the property that we purchased, obviously not through the IRA accounts, but if I were to, let's say, if I'm a person who's really much in control and I'm going to say, yep, I'm going to be 100% compliant with the non-self-dealing rule. Because to me, that itself was really daunting. Like I know myself enough that would never be something I would want to do because just the amount of bookkeeping, tracking, make sure nothing cross-pollinate. It's very, very much difficult for me to do. But if I was someone who's like super buttoned up on this and who wants total control over all my funds, and I've decided I'm going to invest in essentially an active project. Active means it's still arm's length transaction. I have PMs that in place to manage the property. And somehow I was able to get a non-recourse loan on this, or I'm not leveraging the loan at all. So then in this case, if I was to get, again, it's checking with your lender, right? Your lender will tell you this is allowed or not allowed. So, before you even do these transactions, something I always tell my investors and my friends is before you even think about doing certain transaction, do that research like 3 steps ahead. So that instead, setting up a trust and all of a sudden you couldn't do the transaction you want to do, that's not where you want to be. So if you have that friend that is a lender, talk with him and talk about like, hey, is this a structure that you would ever lend on with a non-recourse loan? Because residential lending, they're not going to accept this for sure. But with non-recourse loan, this is another thing, right, that's required with these retirement fund, which is the only lending, like the loan that you can take is a non-recourse loan.
Yep.
Yeah, so basically, if that's a yes, then you can use the trust. But sounds like, John, majority of the lenders going to say no to this. So that may be the reason why you may want to use a self-directed IRA, definitely doing our arm's length transaction while you're holding the properties and et cetera, and do it that way.
Yep.
Okay.
It's like you said at the very beginning, in anything that we're talking about self-directed, there's not one definitive way somebody should go. But if like when I'm visiting with somebody, if I know what their interests are, it can help me give them guidance on what's probably going to be the best structure for them.
Gotcha. Awesome. So cool. I think, is there any questions on the trust by folks? And again, there is, so same rule basically applies to self-directed IRA, to then the self-directed IRA, like the trust structure.
Think of it this way, folks. It doesn't matter if it's the LLC or the trust. That's just the vehicle. It still falls back to what rules are applicable to your IRA as it relates to things like disqualified assets, and other prohibited transactions. The trust is just the vehicle. The LLC is just the vehicle.
Gotcha. Cool. Okay, I think we're ready to kind of get on the start player of the session, which is the Solo401k.
Okay, it can be the star at times. So it's a given, but I put it there. You are the trustee of the plan. You're going to have checkbook control. You do have to just be able to feel comfortable, because I don't require people to prove this to me. It's not my responsibility to be the policeman, but you just have to have some level of self-employment activities that you're conducting on a routine basis with the intention of making profit. And I even tell folks is, how many businesses do we know that are conducting business activities and don't make profit? There are a lot of those. So what's required to set up the 401k plan? There's a registration for the plan. That's obviously what PGI is doing. We provide all the plan documents which are required. They have to be IRS approved. You get what's called a satisfactory opinion letter, that all the documents that are being used for the 401k have been reviewed by the IRS and are compliant under IRS rules. As the business owner, you can not have what's called common law employees. It's not that you can't have a 401k plan. It's not that you can't even have a self-directed 401k plan with employees, but in order to have that solo 401k and to have the benefits associated with that solo K, which means also not having a bunch of IRS requirements because you have employees, the plan has to be either for yourself, or it can be for you and a spouse-owned business. It can be for you and a partner. So if you have a partner with your business activities, that's still considered one. So I always tell people, it sounds kind of funny, you and a spouse, in the eyes of the IRS, that's still considered one. You and a legitimate partner, two people, still considered one. You just can't have common law employees. So if you go out because you're a gangbanger with, getting stuff done, and you're in this business, and all of a sudden you go, hey, I got to hire somebody, and you go hire somebody, if they work more than 1,000 hours per year, they're going to be considered a common law employee. So you want to stay away from the common law employees. If it's a legitimate 1099 person who helps your business, but you pay them strictly as a 1099, and a legitimate 1099 person, they do not count as a common law employee. So the plan can also be set up with an LLC. Now, the reason I mention that, and Elisa's going to smile probably when I say this, is there are some companies that are heavily now pitching this concept of having an LLC that is owned by your 401k plan. We've been doing it ever since we opened the doors with PGI, so that's been 13 years. So just know that you can have an LLC, and I'm going to explain what that is, how it relates to the 401k, but you'll see in parentheses there, it's similar to the IRA LLC. Also, the benefit is asset protection. So let's use a quick example. Let's say Elisa has her 401k plan, and she has $1 million in that 401k plan, but she found some swampland in Louisiana. Sorry, I'm not picking on Louisiana. I love New Orleans, but she finds some swampland down in Louisiana for $50,000, but it's got some crocodiles on it. And she says, I just don't know about the asset protection part of this. So she says, John, I've heard some companies talk about, can my 401k actually set up an LLC similar to that IRA structure? In this case, the 401k would own the LLC. You're just being the manager / trustee of the LLC. Do I have any asset protection now if I go out with that $50,000 in the LLC account and purchase that swampland in Louisiana in case somebody gets bit by one of the crocodiles there? And the answer to that is twofold. Yes, it will provide you some level of asset protection. And two, because we're talking about asset protection, that usually brings up attorneys and that kind of stuff. You should always review things with an attorney. But yes, that is the benefit of having that LLC structure attached to your 401k. Do you need it? No. Will some companies heavily pitch that concept? Yes. Is it a bad thing to pitch? No. I'm just not a huge believer on pitching things real hard as a salesperson. My job is just to say, you can do it this way, you can do it this way. What is in your best interest? If somebody came up to me and they said, hey, I'm going to go out and buy 3 properties with this money in my 401k account, I'd probably say, let's set up 3 different LLCs and use each LLC for each asset from an asset protection standpoint.
Yes,
Go ahead.
That's really good to kind of touch upon, for folks who are doing passive investing into like syndication projects or passive investing lending notes. This is not something that you need to worry about.
No.
What John is mostly talking about over here is if you were to buy a single family home, not leveraged or land or whatever, and you're going to remember the big hurdle for me was the self-dealing part. Let's just assume the self-dealing part, you got everything down to the T. And so then this kind of maybe apply to you because your tenant who lives there, or who knows, the person passed by, there's a liability to it. So that's where they can sue you. And that's where the asset protection comes in place.
Correct.
Right? And if you just kind of passively invest in something, really, I think it's a kind of overkill any type of these LLC. I mean, you should probably still set it up that way just for a little bit more protection. But as a passive investors, I often tell people, like, you can't even invest in your own name. The risk of liability to that is very, very low.
Yeah, and you're exactly right on that, Alicia. So it all depends on the investment. But like I said, in that $950,000 example, $1 million total, it probably is worth having an LLC and just moving that 50,000 and having that LLC own just that asset that might have some risk associated with it, because it's going to keep it separate from the 950,000 that's otherwise sitting over here to the side. And that's where the asset protection comes in. Now, some of the key points with the 401k, I'm going to touch on these really quickly. You have very high contribution limits compared to an IRA. You got 6,000 or 7,000 with an IRA. You have 57,000 or 63,500 for a 401k. That's per participant. So if it's a spouse-owned business, double those numbers potentially. It's all based on qualifying income, of course, but just know that the ceiling is a lot higher for a 401k than any IRA. Number two, investments are owned and are made from the I put Solo K trust because it's technically a trust, but investments are made from either the Solo K, or if you had a Solo K LLC attached to it, it's going to be titled in the name of that asset. The plan and its bank account can be set up at a local bank or a credit union. Now here's where I'm just going to take 2 seconds to explain this, because some companies, unfortunately, do not say this to people. Some companies out there will say, oh, any bank will open up your account for your Solo K. That's not true. Most banks out there will if you explain it correctly, but bottom line is a bank is not required to open this account for you, and they can choose not to open this account for you. But I've never had a customer that has not actually gotten the account opened at a bank. They may go from a first one to a second one, but they end up getting the account opened. The other thing that's nice about what we offer is we're not paid again for any of this, but you can open the account through a brokerage firm. The ones that we work with that participate in this are Schwab, Fidelity, TD Ameritrade, and E-Trade. They are not the custodians or the trustees for your plan. They are simply allowing you to house the account there. So they're not responsible. Like if you broke an IRS rule, Schwab's not responsible for that. They're just allowing you to have the account there. But what's nice about that? You have the ability, if you want to be able to have the funds there, have checkbook control, be able to wire funds out of the account. But if you wanted to purchase some mutual funds, you can. So that's the benefit of it. We talked about the contributions limits there that we were talking about. And then typically the contributions that you make into the 401k are going to be usually classified under a pre-tax elective deferral, a Roth elective deferral, a business profit sharing. We also, as long as we know the client wants this, we can also set up the 401k plan for a Roth conversion, which is really important to some people because they want to actually take money and pay the tax on it now versus getting hit with taxes later. And the premise with that is, do any of us probably logically think that in the next 20 years taxes are going to go down? Probably not. So the Roth conversion is a very good concept for people who have that interest. And then now some of the key benefits here, we talked about the high contribution limits, no requirements for a custodian. So with an IRA, for all you folks that were doing a self-directed IRA, LLC, or an IRA trust, we still under IRS rules have to park that IRA through a custodian. They charge fees. It's just a matter of how much they charge. With a 401k, you're your own trustee. You don't have any custodian fees. You can take out participant loan provisions. Like we mentioned on the UDFI, the unrelated debt financed income with a leveraged real estate investment. You don't even have to worry about that. UDFI doesn't apply to a 401k. We have the ease of the brokerage account options. And then, I think I can read that. There's a reduced penalty structure for an intentional or an unintentional prohibited transaction. So let's say you did something totally inadvertent, you didn't mean to, you had a mistake, and on top of that, you caught it during the first year, and you went to your CPA and you said, oh gosh, I have this problem. Well, guess what? The IRS is actually pretty forgiving on those things. Even when you have a penalty, it's going to be 15% of the amount that's involved in the prohibited transaction, where with the IRA, it's a full prohibited transaction. Your entire account is distributed from an IRS perspective and taxed. So just the 401k is nicer from that standpoint as well.
Yeah, I have no idea that benefits is in there. That being said, obviously they don't do it.
Yes, just don't do it.
Yes. Yeah.
But for those people who, we're going to give them the benefit of the doubt, they unintentionally did something,
yes,
they can breathe a little bit easier having a 401k than they would have with an IRA.
So it's interesting. We have some question over here. I want to kind of dive into the question over here. What is the best entity to set up as a sponsorship of a solo 401k? A sole proprietary, a C Corp, S Corp?
Very good question. That could certainly depend just on what kind of business it is, the risk exposure, the income, that's expected to come in. For example, an S Corp would be for somebody who says, hey, I would like to pay less in Social Security.
Mhm.
I'm going to have high enough of qualifying income where I want to file as an S Corp. And that's going to be typically done as an LLC as well. But that would be a tax savings thing with Social Security. If somebody says, hey, I'm not necessarily making the income to justify, because usually the CPA will tell you you're going to need to make 35 to 40,000 minimum to make the S corp worthwhile doing. For
200K is what
yeah.
my CPA told me.
Oh,
Yes.
okay. But I mean, bottom line is, regardless of that number, I'm glad your CPA used a higher amount. Bottom line is that you have to have a certain amount of qualifying income to make the S corp worthwhile. C corp, I rarely run into people who are
Mm,
self-employed who have C corps. I have a few clients that way, very few. Most of my clients are either going to be S corp or sole proprietors.
mhm.
And as long as people are fine with the sole proprietor structure, there's nothing wrong with that.
Yeah, so I think this question specifically is actually a tax question. So that's again kind of going back to check with your CPA on this. So there's a tax benefit between sole proprietary and S corp. But I just so happen to know this because I asked my CPA about it. And there's a specific amount of filing because there's always a cost effect. There's a basically you know for S corp because the separate tax filing and all the other costs associated. And the fact that once you turn into an S corp, you got to continue going. So there is a limited amount, of number of how much money that you're making justify for these costs to set up an S corp.
Yep.
So there's a specific thing with that. So individually, it's all very different. With Solo 4K, though, I just want to confirm this with John. And whether or not which type of corporation you're actually setting up, the solo 401ks are the same, right?
Yes. I mean, bottom line, as long as there's no common law employees and it's
Mhm.
just you or you and a spouse or you and a partner, et cetera, you qualify for the 401k. Yes.
Gotcha. So that's actually really a key point over here, which means the solo 401k, hence the solo part, is that really it's meant for small business who has no employees or all you have is 1099. So that's actually something to kind of think about the bigger picture, that just kind of picked up on that particular point, John. It sounds like if you were actually hiring people, making them a full-time employee, there is tax benefit to that. For example, you can apply for insurance for corporations and etc. But that's something that you have to wait for because maybe you're no longer qualified as a solo 401k. Then you get into
Correct.
like company 401ks and etc. So there's other vehicle which is not touched on by solo 401k
Yeah,
here.
and for the group here, this will be a key point for them to consider. S corps are great, if you have enough qualifying income to justify it, et cetera. But also keep in mind, now I have some clients who do not do this correctly, but to be an S corp, you also have to pay yourself W-2. So not that that's a huge deal for some people, but it is a requirement that you actually pay yourself payroll
Yeah.
as an S corp versus where you're a sole proprietor. You might just say, hey, whatever I make during the year, I'll figure it out in December. But I don't have to pay myself a paycheck. And I would say, no, you're a sole proprietor. You don't have to,
Hmm.
you don't have to worry about that at all.
Right. And that kind of touches on like, the PPP concepts, et cetera, too. Like all financials, we kind of looking at a full picture on that. And we should be looking at full picture on that. So one kind of last question, I know this wasn't on the Q&A that we have over here, but someone asked me over this. He's going to be listening to the recording. So I want to address this. So he was asking, is there additional tax benefit by having a solo 401k or self-directed IRA as they kind of going forward? Like one line item kind of picking out over here is number 4 over here. So in your opinion, realistically, because I'm in the camp of I don't really believe in retirement vehicles if I employee is not matching. But in your opinion, could this be actually advantageous on tax planning in which scenario that you kind of seeing that you would then kind of recommend that, hey, you're using a solo 401k kind of as a tax deferral as well?
Oh, absolutely. Because again, with the solo, whether they're putting in matching contributions or business profit sharing contributions, it's their account. So, I mean, to me, And I understand because I work with some investment sponsors, as you know, Lisa, and I work with one who says kind of the same thing you do. Is his famous saying is, I hate all 401ks except for ones that are self-directed. So, that's just his bias with it and stuff. And there's a lot of evidence with normal company sponsored 401k plans where people don't actually really increase the value of those accounts that much because of all the fees associated with this. In this kind of a case with a solo K plan, you're going to be controlling the contributions. You just have to qualify to put them in.
Mhm.
But I don't know anybody who would say putting in 57,000 or 63,500 and being able to invest it however they see fit, as long as they're following the rules,
Mhm.
is a bad thing. And then obviously if they want tax benefits of putting them in as pre-tax contributions, they can. If
Mhm.
they don't care about that, they can put them in as Roth contributions. Totally fine. They, as we talked about earlier, even any funds within the plan that are pre-tax, they can convert to Roth if they
Mhm.
choose to. And one of the things we haven't talked about is that is a whole probably other topic besides
Mhm.
today, is the ability to put in after-tax contributions. And a
Right.
lot of people are gravitating towards trying to put in some after-tax contributions because there's some really cool things you can do with after-tax contributions.
Yeah, absolutely. So that's definitely a topic for another day because it actually could get pretty complicated and then requires a consistent contribution to it. And this is something that, at EasyFIU, we're going to dive into with our premium members and et cetera too. And also, if you're interested in that topic, you can kind of follow up with John for that, because I know if we cover over here, half the people were falling asleep over there. So last couple questions, I know John has to go. Is we have a question over here about do you really need a separate LLC for solo 401k? That's a really good question. Or your existing business LLC is enough, or I would even go as far as questioning on, could you be just yourself? Like, let's say some people who set up their business, but they're doing business off, they haven't set up an LLC. Is that LLC required to have the solo 401k?
No, not at all. You can be a sole proprietor. You can be established as what's called an LLC pass-through, where it still is a sole proprietorship, but you say, hey, I'm ABC Company LLC, but everything still flows back to you as the business owner. You can be an S Corp, where you'll probably be an LLC, but you'll be filing your taxes as an S Corp, and then at the top of the chain, so to speak, is the C Corp. To answer what I think might have been the other part of that question, is you do not have to have an LLC to have a solo K, period. But you can't use, if the other part of the question, I'm just trying to figure out the full, the full part of the question. You also can't, if you said, I want an LLC for my 401k, you can't use your own personal LLC that you might already have, because that's owned by you. So if you said, I want an LLC to make investments on behalf of the solo K, yes, you can, but we would form a separate LLC for that. You can't use your own personal or a business LLC for that, because you're personally owning that LLC, and the LLC has to be owned by the 401k.
Gotcha, gotcha. And then, so just as an example, how John set up mine is that I have a LLC that I manage properties with. That's a company essentially, and then the solo 401k is handing off that. But it was set it up as a trust. So the solo 401k plan is a separate LLC. To John's point, it's a kind of a trust account,
Right.
essentially.
Yeah, in the eyes of the IRS, a 401k of any kind, whether it's GE, GM, etc., it's all considered a trust account.
Gotcha. And I think I can answer this question. If no, any payroll, no employees, can I have a solo 401k? So the answer would be yes.
Absolutely.
Yeah,
You'd be a perfect candidate for it.
yes. And then, do any of these strategies works with a Roth? So
Yeah.
self-directed Roth IRA, I've seen them before, very rare. And then there's also a product called a self-direct solo 401k, like a Roth solo 401k, which nobody ever talks about, actually, John.
Right. And
Which
here's
is
kind of the funny thing with that, Alicia, because some companies it's funny how some companies market things. They make it sound like, oh, we do this and it's so special.
yeah.
A 401k is a 401k is a 401k. It's whether or not that plan document permits the person to make Roth contributions or make Roth conversions of pre-tax funds within the plan. Our plan automatically, with all plans, have the ability to do the Roth contributions. And as long as we know the person wants to, because there's some other paperwork we have to do, we can create the plan so that it allows Roth conversions as well.
Gotcha. So a Roth solo 401k is essentially just an after-tax plan for solo 401k. And oftentimes the reason why the mostly common known is self-directed IRA and solo 401k is because majority of people who has past employees, they have a 401k account they need to transfer, which is a before tax product, which is why it doesn't go into a Roth IRA or a Roth solo 401k essentially. but there is a backdoor method to kind of convert it. Again, that will be for another day. That would
The backdoor Roth IRA can get a little. It's an easy concept, but it can get really detailed as well.
Yeah, cool. All right, I think that's all the questions we have. I know we're a little bit over, John, and I know you have somewhere to be. Thank you so much for coming up over here. We have one last question, which is what's the cost associated with setting this plan up? I think it depends the question, but I've used the John in the past. I do my price checkings before I go after certain people. So I can say like their plan is pretty affordable, which is why, I even kind of recommend having him on our show. So John, do you have a last word to add to that question, which is cost associated with these plans?
Sure. So if you're coming in through Alicia, it's on the 401k, it's there might be one or two out there that are just kind of bargain basement places, but it's really about the lowest you'll see. It's $550, and the only additional cost on the 401k is there's an annual fee of $125. By the way, every company that you might work with, they're going to have an annual fee. Typically, the annual fees are 100 to 150 is where most companies are. Ours is 125. If somebody says, well, why do you have an annual fee? Are you trying to line your pockets? Well, it's not really that. We actually have to keep the documents updated and amended and restated when the IRS comes out and says, you have to restate plan documents. That's why every company has an annual fee. The typical range you'll see is from that amount that I just said up to about 3,000. Really, in this core market, though, most companies are going to be kind of in that 800 to 1,200 range, give or take. So we're definitely on the lower end with that. With the IRA, it's a flat one-time fee of 800 plus the cost of the LLC. So if somebody says, well, hey, I live in Colorado and it's $50, we charge the $800 plus $50 for the Colorado LLC, which they would have to be paying for anyway.
Yeah, that's actually really reasonable pricing. Thanks, John. Don't ask me these cost questions. I don't take any referrals or anything. Like I have made my plans before with John, so that's all I can refer back to. So ask
yes,
John for.
And by the way, for your listeners,
Yeah.
if any of you contact me separately, just make sure you let me know that you're with Alicia so I know what correct fee structure to give you. Because they are getting a lower fee structure on the 401k.
Oh, I appreciate it. So here's John's information. If you want to kind of follow up on this, I know some of you guys that's on the call here has been thinking about Solo 401k for a while. It's kind of time to kind of take an action on this. I always try to push people to go take an action if this seems like a good vehicle for you. There's, as you see, there's a different slew of products over there. Mostly is the purpose of doing that. If you're happy, invest in stock, don't do it. But if you wanted to use it to invest in alternative resources like notes and the passive investments and all the other kind of alternative investment, then maybe it's the right vehicle for you. Yeah. All right. Well, I'm going to leave this up, and thank you so much, John, for your time. And I will send out the recording to everyone here, including this material over here to share for John as well.
Can I add one quick thing?
Yeah.
I forgot to put in there, that's the website. If anybody wants to email me directly, it's just John, John, at PGI SelfDirected. So I forgot to put that in there, but that's
yeah, we will share that information. We'll edit it and share that information.
Sounds good. And I want to thank you, Alicia, and I want to thank everybody out there who was patient and listened to this boring old guy talk for a while.
No, it's very interesting for us. Thank you so much, John.
You're welcome. Everybody have a good day.
You too. Thank you.
Goodbye.
Bye.